Hi, welcome back to our series on business finance. And this is all about how to gauge both systemic and non-systemic risks and influences on your small, medium-sized business or your startup. And so today we're going to actually start a series on liquidity access. What is liquidity? Well, it's cash, right? Now, why are we talking about cash and liquidity? Well, because we're kind of coming out of a time period, let's say the last 15 years, where most businesses have been flush with cash. Now, there's two sides to this coin. Too much cash on your balance sheet, well, that's not a good thing either, right? On the flip side, not having enough cash, or better yet, it's not about the cash number, it's about access to cash. So I know a lot of small business owners, especially after PPP money, EIDL money, the last 4 years, well, a lot of us have had the cash on the balance sheet. Others have used that cash, well, to kind of offset some losses on the P&L. But having access to cash is very different than having cash on the balance sheet and very different than not having any cash. So let's talk a little bit about access to liquidity. So I'm going to go a little bit deeper into banking relationships. What does it mean with a tightening credit cycle that we're sort of experiencing, higher cost of capital? And 3, recapitalization of your balance sheet through, well, maybe private equity, family money, etc. So having access to cash, it really starts with having good banking relationships. It also is, well, staying focused on the ball, right? Financial planning and analysis is one of the best ways to mitigate not knowing what cash position you're going to have in 3 months, 6 months, or in 12 months. And the best part is you're always going to get that number wrong, but at least you're adjusting as you're going along. So when we talk about having access to liquidity, it doesn't always translate into having cash on the balance sheet. Cash that's just there, it's stale. Yes, we all love having cash on the balance sheet. We like having cash in the bank account because we sleep better at night. But it isn't always the most, well, efficient use of cash, especially for non-inventory intensive businesses. Now, in the professional services world, you can kind of have a better sort of rhythm on cash in, cash out. You pay your employees once a week or every other week, or you're getting cash from your customers once a month. And for those of us that do maybe some more of the transactional type of revenue, that gets a little bit choppy, but that's really easy to at least plan out for a few months. So short-term cash. So when we talk about this access to liquidity, it also means, like, if you don't have a ton of cash on the balance sheet, but just enough to kind of go with the ebbs and flows, opening up a line of credit is another great way to create access. You may not need it, and for most of us, you probably don't even have to pay to have that access, but it's just nice to not have all that cash on the balance sheet because most of you are owners, so if you have nowhere to put the money to invest in the business, why is it on the balance sheet? You should at least maybe think about distributing the money back to you or paying off some debt, etc. Having access to cash is important, and in the next 3 videos, we're going to be talking about banking relationships. We're going to talk about the credit cycle and what that means for our businesses. And the last piece, because it is a hot topic, there is a lot of dry powder on the sidelines just waiting for the softening of the economy. What does it mean to engage with private equity to recapitalize your balance sheet?